Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And I'm just going to tease it. We've got a fascinating guest coming from an international location, I will not spoil the story, Ramsey. But welcome. Glad you're back.
Great to be here. Great to have this guest and get it going.
Yeah, and I gave you a little bit of a hard time on the air last time, but I know you squeezed this in between some important work, so we appreciate it. Ramsey, good to see you, and I'm going to let you tell people who we have on our show this week.
Sure. So today we're joined by Devesh Shah, who is an old friend and colleague from the many years I worked at Goldman Sachs, and he's somebody that has a really unique perspective on both money management from an institutional perspective as well as personal finance perspective, which is something that he's focused a lot on in his post-Goldman years. So I just want to get into the discussion because I think that we're going to be able to uncover a lot of things that I think will be valuable to the listeners here. And actually, there's just a lot of fun parts of the journey that Devesh has taken. So with that, I'm going to turn it over to Devesh. And Devesh, first talk a little bit about what you did at Goldman and what you're doing now. And then we're going to get into one of the hallmark moments of your career, which was reinventing the VIX, which is something that is a tool that everybody uses these days, and how that came about is a fascinating story. So with that, Devesh, tell us about yourself and your journey.
Sure, yeah. After graduating from college, I worked in actually the fixed income markets for a few years, where I worked at Merrill Lynch trading Latin American currencies. And before that, I had spent some time at Salomon Brothers trading interest rates, where I was a summer intern actually at Salomon Brothers, but on the trading desk. And then I joined Goldman Sachs in the year 2000, where I started on the equity derivatives desk. It was very much like today, the boom years in the equity markets, and the entire equity derivatives trading desk on the index options area had just quit. And so they were looking for young traders, and I was lucky enough to be both young and a trader at that time. So I joined Goldman Sachs, and a group of very talented individuals from Tokyo and London had joined the team as well. But then in a couple of years, they all quit once again to join another part of Goldman, and so very fortunate that I had received a lot of responsibility very early on in my trading career, and by nothing of my own doing. People, just wherever I go, people tend to leave. So it worked out that I spent a lot of time interacting with clients, and I spent a lot of time understanding client needs and trying to figure out how to use what we could do at Goldman and in serving clients. So I was on the client-facing desk for many years. In the early era, if you remember what we call the aughties, before 2008, before the Volcker rule and everything, proprietary trading was very much a part of the culture, along with client trading. And so at Goldman Sachs, our desk and the desk I built over the years was very much involved in proprietary trading as well. And we took a lot of risk on the equity markets, mostly all on the index side, and also in equity options, and all on the index side. Through the process, we created a bunch of fascinating instruments, and some of these things already existed outside of Goldman, like variance swaps, which were traded elsewhere but not at Goldman, and so we started that business at Goldman. And because I was very lucky to be involved in starting that business at Goldman, I got the inspiration and the know-how to reinvent the VIX index, and we'll talk about that in a little bit. But I continued at Goldman until I was a managing director and then a partner. And then at some point, I felt like a lot of the things that I'd come to Wall Street for, I'd achieved. And so I decided to leave Wall Street. I took a break for a few years. I worked at a hedge fund for a few years. And then over the last several years, I've been doing fairly creative pursuits, I'll say. I've written a fiction novel which is not yet published. I've written another nonfiction story called Letters to My Sister, which are about financial advice or financial wisdom that's worked for me, that other people have shared with me and that I want to share with other people. And then most recently I've started a YouTube channel which has over 75 videos on it, where I share a lot of these ideas on personal finance that have worked for me and which I think are most likely to work for other people. So that's what we have for the last 23 years.
That's fantastic, Devesh. And I want to say it's pretty amazing that you got onto Wall Street and achieved everything you wanted to get out of it in a relatively short period of time, shorter than most. So well done. Let's talk about the VIX. So that's one of your biggest claims to fame. Certainly the one that folks outside the insurance or outside of the financial services industry would be most familiar with. Tell us about how that happened. Like, it began with a call on the desk. What did that look like?
Yeah. So the VIX, as you know, was actually created by the CBOE in 1993.
Who are the CBOE? That's the Options Exchange?
The Chicago Board of Options Exchange.
Yeah.
The Chicago Board of Options Exchange itself was created in 1974. And it was an offshoot of the Chicago Board of Options, CBOT, Chicago Board of Trading. And they traded their first options in about April of 1974. And the Black-Scholes equation was published in May of 1974, right? Which was phenomenal timing, because that's what helped bring this entire options revolution that we've witnessed for the last 48 years. Without the Black-Scholes equation, we would not have had that. The CBOE, which is Chicago Options Exchange, was created specifically to trade options. And, for 10, 15 years, the options market grew slowly. We had the 1987 crash. When the markets went down about 23%, 25% in 1987, for the first time, they discovered that, hey, maybe we could use put options as a way to hedge our portfolio. Right? Remember, there was something called portfolio insurance, which was used prior to 1987, and it was said that, okay, we could just dynamically rebalance your portfolio. You don't have to use put options to hedge your portfolio. 1987 happened. The portfolio reinsurance people lost a lot of money. Put options went up a lot in price, and then slowly people realized maybe we need to kind of document volatility itself, which is how options are priced, and the essence of the Black-Scholes equation. So in 1993, they came up with the VIX index. When they came up with the VIX index, the idea was actually that they were going to trade VIX options and VIX futures back in 1993, right? So they were very forward looking at that point in time, except that they thought of the VIX as IBM stock. Hey, we can trade options on IBM, we can trade options on the VIX, right? And the VIX being volatility and not having anything underlying it except just the prices of options, it's really, really complicated. And so it wasn't possible really to trade futures or options on it for a while. Now, chug along, the market for options advances and we get to other products, right? But then after the dot-com boom and then the dot-com bust, people realize markets do crash. And this is not the only time markets have crashed. Markets crash again and again. So in 2000, March 2000, NASDAQ peaked. September 2000, S&P 500 peaked. Things slowly came back up, right? And May of 2002, the market had bounced back quite neatly right after 9/11, because the Fed had cut a lot of interest rates and the market was going up. And then Mark Cuban calls, our private wealth management, because he was a client of our private wealth management at Goldman Sachs. And Mark gets on the phone with me and says, hey, I have a view on the market. I think the VIX is going to go up a lot, and I would like to buy the VIX. And obviously at that point the VIX is not tradable, and me being a good customer facing representative, I tried to pitch him all kinds of different things which would also make money, right, when the market would go down, just not the VIX, because you couldn't trade the VIX, right? And Mark said, that's all good, but I'm not interested. If you can't trade the VIX, I don't want to trade. Fine. Right. Now, the problem with a bright person giving you a challenge like that, right, is that you start having sleepless nights. And my problem was that, this is absolutely gold mine, because here you've got, a can which has Coca-Cola written on it, and somehow nobody can open it and take a sip from it, right? And somehow we've got to change that, right? So what can I do to change that? And I spent enormous amounts of time thinking about it while I was just running and managing the index derivatives books as it is. And then one day I ran into Sandy Rattray, who at that point was in derivatives research. Now, Sandy is a far more accomplished individual, and he is the CIO at the Man Group today. At that point in time, Sandy was working on some pension fund problems. And he said, Devesh, that's so much more exciting to think about how we can make the VIX work. Tell me what you've thought about. And so I told him, I can do this, I can do this, I can do this, but these are the problems, right? I'm really trying to bet on, where volatility is going to be in the future. It's like allowing people to make a bet on where the temperature is going to be in the future, right? That's kind of really hard. And so Sandy and I went back and forth many times after that, and he gave me some ideas about something called clique options, which were traded by the structured products desk, right? We won't go into that right now, but the idea was that somehow some parts of derivatives trading did use some element of being able to trade volatility in the future. So I went and spoke to them, and one conversation leads to another, and so on and so forth, right? And then one night everything sort of like came together. And back in the day when I was at Solomon Brothers, I'd learned a lot about Eurodollar futures trading. And Eurodollar futures are basically forward interest rates. And I figured if you can trade forward interest rates, you can create something similar in volatility and create forward volatility instruments. And we used another volatility instrument called volatility swaps or variance swaps. We repackaged the idea and basically made it into the VIX. And we won't go into the details, but I have a video on my YouTube channel which goes exactly in the details of how the VIX index was created. So if you're very interested, you should go and take that look on my YouTube channel. But we created the VIX, and then we went back to Mark Cuban, a year later, saying, hey, by the way, we have the VIX now. And he said, too late. Sorry, the market's already broken. The VIX went up as I predicted, but I don't really have a view on the VIX anymore. That's fine. But then, a lot of other people got involved starting 2003, 2004, 2003. We pitched the idea to the SIBO, and the SIBO went to the S&P Standard & Poor's. Goldman, Standard & Poor's, and SIBO came together. We put this index together, and boom, we listed the futures on it, and that's the rest is history.
So now there are tons of products that are based on the VIX that are actively traded and built by any number of folks on the street. And so it's an amazing story because it was inspired by a phone call, something you couldn't get out of your head. And Mark Cuban never ended up buying it, but it launched an entire new segment of the industry. So
let me just ask you, Devesh, this is interesting idea. I love the Coke in a can. You crack that thing open. How much value totally? I mean, do you have any? Can you put a number around what Ramsey just said? Like how much market value, market trading, market whatever was opened up because you solved this?
I wouldn't know how to do that, because I think I now know, right? If you look at banks and how banks manage their risk, right? They use something called the VAR, value at risk. And if you go to a bank, right, they have like 500 different trading desks, each one of them trading different products. At the end of the day, the CFO of the bank wants to be able to tell the investors, we have this much at risk. How do they come up with that one number which represents 500 different trading desks, right? And the answer is, it involves a lot of things, which, the spot risk, credit risk, foreign exchange risk, but then all of that still has to be brought together, and that's brought together by volatility. And they look at two volatilities. One is they look at the past volatility, what we call the historical volatility, but the second thing they look at is something called the forward-looking volatility. And because we have a very sophisticated forward volatility market in equities today, and because we can apply it across the world, we can apply it to across other products, the same formula, the same way of doing things, in a way, banks as a universe are able to calibrate their risk so much better. Because if you get into a situation where things may have been quiet, but something big is on the horizon, a Brexit vote or an election, then implied volatility in the future is going to be much higher. And all of that feeds into the risks of the trading books. And the risk managers and the CFOs of the banks can put it into their equation and say, what, even though it doesn't look that risk was that much higher, it's increased. And so I need to be making sure that my traders are more responsible than they were in the past. And that's just one sector from the bank side. If you look at insurance, if you look at direct investments in hedging and VIX and volatility, I think that the applications are just enormous. And I certainly don't claim credit for all the applications. I think that part of the story that I tell on a 10-part derivative series on volatility on my channel is that we've all stood on the shoulders of other giants who have come before us. And without people having started the business in 74 or started, or written so many papers before that, we would not be here today, right? So, a lot has happened, but it's because everyone has worked hard to creatively apply it in their areas. And I don't have a number for it.
Ramsey, what do you think? $1 trillion drink of Coke each year, maybe?
Well, it has to be. So there's the actual trading around it. And then two, there's this benchmarking, which is Devesh is saying that everybody has to figure out how risky is my book. And the books are trillions of dollars, right? If you add up all the banks in the world. So they have to benchmark to something. So if you count the benchmarking, you count the actual trading, it adds up to a ton. And before we got on the air, Devesh was talking about just the book he managed at one firm, and this was probably like 10 years ago, right? So and the market's much bigger. So just give us a quick idea. You talked about like your P&L, your profit and loss for one sort of 1 point move in the VIX in either direction. You had a number for that. And the other one you had was, okay, how much stuff do I need to buy to actually hedge that risk, which was also pretty substantial. So give us those two numbers quickly and a quick explanation of what each of those mean.
Sure. So this goes back, more than 10 years. This is during the years when it was acceptable to take risk on Wall Street as trading desks, right? And today with the Volcker rules in place, I think things are much, much more narrower in perspective. So having said that, right? So, I think that because we were involved in the creation of the VIX and we understood the dynamics of the VIX so well, and we understood, what was happening with volatility and, so well, right? One of the things I did is that when volatility collapsed in the end of 2006, the VIX was below 10 at that point in time. I and the desk that I worked on together, we made a decision to build a large position in the VIX where we went long the VIX, right? With the idea that, volatility could go up for a multiple number of reasons, and it seems low right now. And, we were proven right in 2007 when the markets crashed, and then in 2008, once again, when the markets crashed. Goldman Sachs at that point in time, and I've learned over the years that many other volatility trading desks during those years had similar positions. And so, but we were lucky enough that we had the right position. The VIX had collapsed and we were able to buy it. We made a substantial amount of money. The amount of risk we were taking at that point in time is that for every, point in the VIX that the VIX went up or down, we had an exposure of close to $30 million. So for each, if the VIX went from 10 to 11, we would make $30 million, right? Now, it's kind of cool to just say that it's as simple as that, but one of the things that Wall Street banks, because they have taken risk for such a long period of time, are really good at is managing their losses, right? Now, not all Wall Street banks are good at managing their losses, but Goldman particularly was very good at making sure that we kind of managed our losses fairly well in the trading books. And when things got crazy in 2007 and 2008, and the VIX was gone from 10 to 20 to 30 to 40 to 80, right? Things get very complicated as far as risk management are concerned. Because it's one thing to say that I have bought the VIX when it's at 10, right, through VIX futures, and it can only go down a couple of points. I can only lose a couple of points in my VIX futures. I know exactly I'm going to lose $10-20 million. But when the VIX is at 50, the VIX can come down to 20, and I can lose a lot of money, right? So taking risk is not enough. As the market evolves, the risk changes in many ways. And Goldman's concern was that if the VIX came down a lot, we would lose a lot of money. So we hedge our books. All derivative books at banks are mostly hedged books. What that means is that we try to pinpoint what risk we are taking, right, and eliminate as much of the risks that we don't need to take. Ramsey, at that point in time, the markets were moving so much that nobody knew what version of Black-Scholes equations to use. On our trading desk, we used 5 different Black-Scholes equations. Right? Now, there's only one Black-Scholes equation, okay? But we used 5 different versions of the same Black-Scholes equation. And the reason is because we were trading volatility. And every time the market went up and down, volatility is supposed to go up when the market goes down, right? And go down when the market goes up. But these relationships are only nice in storybooks, right? In reality, things are very, very complex. In the 5 different models that we used, in order to calculate my hedge, in the minimum versus maximum version of the risk, my market exposure would have been different by $500 million. Okay.
That's remarkable. Yeah.
And the point being here, sorry, go ahead.
No, I just had a quick question, and to kind of bring it to present day, because I love this story and I love the journey that you've been on. But like currently, from a to bring it back down to basic investors or yourself, how are people using this index now to their advantage? Given that it's supposed to predict, right, volatility, given 30 days out or 60 days? I'm not sure what the duration is, but how are investors using it, or do you not advise investors to use it?
I've been very clear in my position that unless your name starts with an M and your last name starts with a C, so it's Mark Cuban, just spell it out, I would be very careful trading the VIX. I've put that out many times before. Are there people who do a phenomenal job taking positions in the VIX and making money? Absolutely. And I think I can count them on one hand how many people there are who can do that, right? Which means that almost everyone else is subsidizing, the private school tuitions of those five people's children. So, you know, these things are very, very complicated. Most people think it's as easy as buying some VIX option or trading some VIX ETN or some call or an VIX ETN. I'm sure this is going to happen, that's going to happen. None of it happens. It's far from the truth. These things are extremely complicated, right? So they are a very glorified form of market timing. And if I told you, Will, that your job starting today, right, is just to trade the S&P futures up and down all day long for the next 6 months, right? You would say, Devesh, I think I like my job. I don't need to do that job, right? But there are a lot of retail investors out there who would be happy to take the job that I just described. Trading VIX options and VIX ETNs is just, trading S&P futures thinking that, oh, but this is much easier. Oh, I understand it. And sorry, you don't. People need to get the gambling out of them, and so they have to do it.
So this is sort of the key thing here is that, and we can segue a bit into what brought you into personal finance, because I think hopefully by now with these remarkable stories, people understand that you're a person that understands risk. It understands risk at a very granular level, and lived and breathed it in a very sort of large size in a way that not everybody would have the temperament to do. So you have as thorough a background in this as possible, and at the same time you see retail investors engaging in activity and who have some degree of confidence around it. What might you say to them, knowing what you know, and I think you were gentle in what you said before about don't hold back.
No, I think it's so easy to tell other people what not to do. It's so easy. I mean, we all feel like we are experts at something, and we know what doesn't work. I want to say that I've eaten a lot of my own humble pie, and that's what gives me the confidence and the conviction. So as you pointed out, I traded volatility and invested in the markets at, I think, the highest level of what could be traded. Okay. And then when I left Wall Street, I thought this is easy. I don't even have to make the kind of money I made at Goldman Sachs. I just need to make a fraction of that money for myself and I'm all set, right? And I don't need to do it every day. I just need to do it a few days a year. I just have to get the market right in a few days, and that's it. I can tell you that the reality is, couldn't be any more different than what I thought it would be. It was just spectacularly bad. First of all, once you get the trading bug, which, because I was a trader, I already kind of live on that trading drugs. It gives you a high to kind of trade and be trigger happy. Once you start trading, you want to do it all the time because you think, I just know today is the right day, right? And like, why? Did the sun tell you something? No. But, somehow, so you fall in that trap of over trading. Second is that the golden rule of trading, right? And this is what every successful hedge fund manager knows, every successful investor knows. People like Warren Buffett have said, 1 billion times, right? You have to have some edge in what you're doing. What is it that you know that other people don't know? What is it that you know that other people don't know, right? And when I'm sitting in my home office with my nice fancy iMac, thinking that because I have a history of trading derivatives, clearly I am better than everyone else, and so I should be able to make better decisions, I forget that today there is nothing I know more than what anybody else knows. And so I have no edge. And that's why it's difficult for me to make money. It's not personal. It's just that I don't have edge. And so I will say this to every investor out there who thinks that they can trade calls, puts, futures, or any kind of derivatives. Ask yourself that. What is it that you know that other people don't know? And if you honestly ask yourself that question, you will say the answer is zero. Okay. And so if you start with that honest process, then the answers start making sense as to what one can do. But that's the foundation, I would say.
Well, let's double click even deeper into that. So, Devesh, as you know, we sell annuities, fixed index annuities, marketed for years as sleep at night insurance. Ramsey, buy this insurance. You're never going to lose anything in the marketplace when that crash happens. Now, big drops. Guess what? Our whole market grew. Today it almost feels, Devesh, like there's, and you kind of were talking about that overconfidence. People say, "Oh, fine, the market's down. I'm just going to sit it out. I'm just going to buy more. I'm going to buy in the dip." Do you think that our environment has fostered overconfidence among far too many people in the market today?
Yeah, well, I think we are all a product of the circumstances to some extent. And when circumstances persist for zero interest rates persist or close to zero interest rates persist for over 13 years, 14 years, people do what works in the new environment until the environment changes. So I think that it's incredibly important to cover your downside, to think about what is your hedge effectively. And, when you are all in risky stocks, all in on crypto, or whatever it is, right? It's not 401k, it's 401k9 now, for Dogecoin or something like. So,
First time I heard that one.
yeah. So when people have been trained that works, they're going to keep doing that. And then once it stops working, then we will relearn the lessons that we have to learn. It's the saying which smart people have said, which is like, don't risk what you have and need for what you don't have and don't need. I think that we don't want to listen to that, but I think it's incredibly important to be protected through your downside, in whatever way that makes sense to you personally.
All right.
Yeah.
So you built this amazing career. You tried to do it on your own, had a reality check. You re-examined things, and you thought, here's an opportunity to start educating people. You have your YouTube channel, and you also wrote this book, Letters to Your Sister. So what was the evolution of that? I'm mindful of time, Paul. Like, how much time do we have left, roughly speaking?
About 10 minutes.
Got it. Okay. So what inspired you to start writing these letters to your sister? And what were the things that she was encountering that you saw, the questions you thought needed to be answered about managing her personal finances?
Sure, yeah. There's two components to the answer. The first is that, for a while, I spent a lot of time writing about what one should not do. Right? Don't do derivatives. Don't try to do leverage trades. Don't do this, don't do that. And the reality is this. No one wants to spend time listening about what not to do, right? Unless you're going to, also tell them what the solution is, right? And so a smart solution has to be in place. And I spend a lot of time thinking about what that is for me, so that's one thing. right? And so when I was thinking about what that solution is, I read every single book on personal finance that I could get my hands on. And I spent as much time talking to people who were about the age of 70, because I wanted to make sure that these people had done things, been there, and lost money and made money. And I wanted to know what worked for them through the cycles. So I spent a lot of time talking to all these people. And the one book that I felt I could really sink my teeth into was David Swenson's book, Understanding Personal Invents. Unconventional Success is the name. It's the name of the book is Unconventional Success, and it's called Understanding Personal Investments. David Swenson passed away a few days ago, as you know. And I think he was a pioneer in investing, not just for institutions, but he wrote this book for individual investors. Now, he didn't need to write this book for individual investors because he didn't have any products to sell to individual investors. He did this purely out of goodwill, right? And this is a fantastic moment to thank him, because I think that a book of that nature. Now, as I told you, that I have spent a lot of time really focusing on risk and understanding financial markets. I had to read this book about 5 times to fully understand what David Swenson was trying to say, what I needed to do to get my personal investments right. Okay. And there's 2 reasons to say that. First is that it's not easy. Okay. It's not easy even for some people who know. And second is, there is material out there. So if you really want to learn, you can learn it. Okay. Now, I started doing this for myself. I started applying the lessons from this book for myself. And, fortunately, I did it in time because, I've been rewarded by the markets in the last many years as a result of that. One day I was talking to my sister who lives in London, and I'm visiting her in London right now. And I asked her what she was doing with her personal investments. Now, she runs a very large tax advisory at a large private equity firm globally. And so she's very clever, probably far more clever than me. And I asked her because I wanted to learn something from her. And she said that, she and her husband could never really figure out what works for them. So they went to a brokerage house. No, it's not exactly a brokerage house. It's like a financial advisory brokerage house. And they charge them a 6% upfront fee, which gets reduced by 1.5% every year, right? As long as they are invested in their mutual funds, which charge 1.5% every year. Okay. And I kind of was in disbelief that how could this happen in today's day and age? Like, do people not know the story of what Jack Bogle has started with Vanguard? Do people not understand that there are simple ways of investing? Has everybody not read David Swenson's book 5 times, right? And if not, why not? And the reality is people don't have that much time. It's hard enough to be good at your job. It's hard enough to save, earn money and save it, and investing is really complicated. So I wanted to create some different kinds of media for people to understand about financial investments, and one of them was the YouTube channel that I've started, and the other one is through these letters to my sister, which I have written, which is an unpublished book, so please don't go looking on Amazon for it. But if you are a publisher, please call me. So the idea is that it's important to tell stories about personal finance and to reach as many people as possible. And people are going to learn in different ways. And just because there is a lot of garbage out there that I don't like, that doesn't stop me from doing something right, even if it's not particularly sexy or exciting.
And you offer this knowledge gratis. Like, you explicitly don't want to get paid for it. You want it as a public service. You want people to either watch your videos, or if at some point you publish your book, I guess I'll have to pay $10 to get or $15 to get the book. But this is mission oriented as opposed to profit oriented.
Absolutely, Ramsey. I mean, I kind of think about each one of us. We are so lucky to be, we are privileged to have the careers that we've had, and so many people have helped us along the way.
Yeah.
And
Hey,
yeah, we just have to return that favor. So.
Well, this is great, and Devesh, we'll make sure that we get your links and put them in our show notes, and let listeners, find your channel and your writings. Ramsey, this was terrific.
Devesh, thanks for taking the time and sharing your story and your wisdom. It's always appreciated.
Thank you.
Yeah, Devesh, very, very much appreciated. I'll read the book, not 5 times, but the David Swenson book once. Yeah, and but thank you very much for sharing it. This is a kind of show where we want to keep talking to you because we want to hear more about your story and why you left Wall Street when you did. So maybe we can have a part 2 at some point and hear more about it. But it's been really great.
Thank you.
Yeah, Devesh, thanks so much. Ramsey, Will, listen, and thanks all our listeners for joining us. Give us questions, feedback, share this link and this show with your friends, and tune in again next week for another episode of
Subscribe to Devesh's YouTube channel.
Yes, subscribe. We'll put the link down below. Subscribe to Devesh. Thanks so much.
For listening.
Thank you, guys.
If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.